Hello, very good afternoon to all, and welcome to today's Daily Dose of Market Insights. I'm Kelvin here again. Very good afternoon. Today will be Thursday, the 12th of February, 2025. So before we start our Daily Dose of Market Insights, let's have a quick look at the disclaimer first. All right, leverage trading carries a high degree of risk and may not be suitable for everyone. Losses can exceed deposits. This presentation is not an offer or solicitation to buy or sell, nor financial advice or recommendation for any investment product, as well as any forecast, prediction, projection in this presentation is not necessarily indicative of the future or likely performance of the product. Excuse me. Excuse me. This advertisement has not been reviewed by the Monetary Authority of Singapore. Okay, so as usual, before we jump straight into today's short-term intraday technical outlook with the key levels to watch on our broad-based cross asset classes, let's have a quick recap what has taken shape yesterday in terms of news flow, key economic data, if there's any, and as well as the intraday performance of the major cross asset classes ranging from the FX market, the major stock indices, and as well as the two key commodities markets, which is gold XAU/USD and the West Texas crude oil. So let's start with the major US stock indices first over here. Okay, so let me highlight my screen so that you guys could actually take a look at it. All right, so basically if you look at my screen over here, is that what you could see yesterday, it was rather a lackluster sideways movement on the major US stock indices. So the SPX almost ended sideways unchanged, so it traded the entire US session more like a sideways action, almost ended unchanged. The Nasdaq 100 underperformed, down by negative 0.3%. The Dow Jones managed to actually hit a small gain of positive 0.28%, and the Russell 2000 also underperformed by negative 0.5%. So if you look at the heat map of the S&P 500, where we actually managed to actually digest or dissect the key 500 component stocks of the S&P 500, and we break it down according to the various sector. So we start to see more rates in the mega cap stocks. All right, so how do we know it's mega cap? By looking at the area of the box. Okay, so all these are very big boxes, so these big boxes represents market cap. So we know that there are actually we call it the mega cap will be about 5 of them: Microsoft, Apple, Amazon, Tesla, Google, Meta, and Nvidia. So what we could see over here is that in fact 1, 2, 3, 4, 5, 6, 7 mega cap stocks, pardon me. So we start to see there are more reds than green. So the worst hit was actually Tesla, down by negative 6%. And the only one that is appearing in the green was Apple, up by positive 2%, and Meta up by 0.34%. So net overall, what we could see over here is that participants was rather lethargic towards the intraday performance of the major US stock indices. And one of these lethargicness could be also primarily due to a less dovish portray by Fed Chair Powell. So like I did mention yesterday, Fed Chair Powell will do his semi-annual testimony to Congress. So yesterday he addressed the Senate. So this is the key takeaway. So the key takeaway from his testimony over here is that he is in no rush of adjusting rates further at this point. That means, i.e., he do not see a rush to, in fact, kickstart a much more, we call it a pronounced interest rate cut cycle. Because do not forget, the Fed is still the guidance currently right now is still an interest rate cut cycle that kickstarted last year autumn over here. And what's interesting over here is that after Fed Chair Powell, we call it a speech yesterday, or I'll say testimony to Congress, what we could see over here is that the CME Fed Watch 2 now has only starts to price in one interest rate cut for this year. So no change on 19th of March, very high chance that the next meeting will be on the 19th of March. So very high chance that the Fed will maintain status quo at 4.25% to 4.5%. That means no cut. High chance. How do we know that? Because market is looking at the market. That means, i.e., the market I'm referring to is the Fed funds futures market, is looking at the 96% chance that the Fed will maintain status quo based on latest relevant data or information flow. And the latest relevant data and information flow came yesterday from Fed Chair Powell testimony to the Senate. And if you look at the aggregated tab basis, where we are able to see the pricing across the curve, that means heading all the way down to the next meeting into next year as well, 9th of December 2026. So if you look at the latest pricing over here, is that market is now expecting a higher chance to come in July instead of June this year. So June this year, 18th of June, this week we take a look at it, it was hovering at around 60% to 70%, but now based on the latest pricing, it's dropped down to 58%, less than 60%, slightly below, and the higher chance of 70+% or 74% to be precise, to be come in on the 30th of July, high chance of 98% to come in the month of September, and 29th of October at 81%. So what we could see over here is that market now is looking for only one interest rate cut to come in either the month of July, September, October, or December. Okay, in fact, these 3 months, July, September, October. December, not that great. That is only 60%. All right. But however, previously in the month of December, there's actually 60% chance to bring it down lower by another 25% basis point to 3.75% to 4%. So at the start of this week, there was a slight chance that there could be potentially 2 interest rate cut of 25 basis point each for this year. But however, based on the latest relevant news flow, which is Fed Chair Powell testimony to the Senate yesterday, saying that he's in no rush of cutting interest rates at this juncture, taking things one step at a time. And he also did roughly mention that Trump tariffs, not a rather strong stand. He said that it's still pretty much data dependent, but there's a risk that it will be inflationary in nature. So market is looking at it as the Fed is likely to be lesser and lesser dovish in 2025 versus 2024, and that skew the pricing to only one interest rate cut this year in the CME, as being priced by the CME Fed Watch 2. So that's why a tightening liquidity condition implies that there's a risk that the US earnings may not be so great, because if we have a longer term of cost of funding, it potentially reduce, we call it earnings growth in a way. Okay, because of do not forget, corporations still requires financial leverage in some of them, but net overall, that's actually have a kind of a knock-on, not so positive knock-on impact on the major US stock indices yesterday. And what's interesting over here is that the longer term benchmark cost of funding using the 10-year US Treasury yield also started to show signs of a bullish reversal as well. So if you look at the last 1, 2, 3, or 5 session, it starts to actually shape a V-shaped recovery after a test below the 50-day moving average, and this V-shaped recovery occurs close to the former major bullish flag resistance, now turns into a pullback support over here, as you could see in my screen. All right, so this is the 10-year US Treasury yield. Okay, so there was this pullback support here. Okay, so which is a zone. Okay, this zone here, 4.4% to 4.33%. Okay, it bounced off from here, and right now it's trying to actually reintegrate back above the 20-day moving average that was acting as a resistance since 23rd of January this year. So if it starts to break out above this 20-day moving average, now acting as a key intermediate resistance, which is at 4.55%, potentially, right, we could start to see another impulsive up move sequence for the US 10-year Treasury yield, in line with this ongoing medium-term uptrend phase that is still in place since the low of 17th of September last year. So net overall, with the rise in the US 10-year Treasury yield, and as well as if you look at the 2-year, the shorter term tenure, the 2-year Treasury yield is also rising as well, and the 2-year now managed to actually break out above the 20 and the 50-day moving average, and now trying to reintegrate back above the 200-day moving average. So what I could see over here is that rising fixed income yield from US potentially will also lead to a firmer situation for the US dollar. So if you look at the yesterday US dollar prices, it starts to actually traded sideways, but the dollar didn't actually collapse much against the other major currency over here. And what's interesting over here is that the dollar yen managed to do a spike up over here. So later we touch on the short-term intraday technical outlook for the dollar yen. So the dollar yen did a dramatic spike up yesterday, given Fed Chair Powell not so dovish remark, and to me I found it is rather mildly hawkish instead. All right, so that's for the situation on the FX market and as well as the major stock indices. And for because of the movement, okay, because of the less so-called dovish speech by the Fed, right now we see gold price after rallying in the past 1.5 week or so starts to do a bit of consolidation. So gold price later I'll touch on the short-term intraday technical outlook. It actually can't break above the 2005 2010 intermediate resistance and starts to trade slightly below it yesterday. So it starts to see signs of a consolidation after a very strong bullish run in gold in the last 1.5 week or 2 weeks or so. And also West Texas crude oil actually rallied slightly as well yesterday. So due to the fact that number one, potentially there could be some supply shock coming into the market. So that's explain the movement of the mildly bullish movement on the West Texas crude oil yesterday. And one more particular news flow I'll share with you is up early today's Asia session is regarding about Alibaba. So we know that Alibaba is one of the key component stock in the Hang Seng indices, both on the Hang Seng Index and the Hang Seng Tech. And right now, Alibaba, there was a news flow saying that is trying to secure a local partner to provide iPhone AI. And one of the news flow is saying that Apple is working closely with Alibaba, okay, to roll out artificial intelligence features in China. So, but market is actually taking this as a positive step. If you look at it, why? Because of the all the major US, all the major so-called Hang Seng indices is actually in the green today after shipping a minor loss yesterday. So we know that yesterday we do have a bearish bias on the Hong Kong 33 that's representing the Hang Seng indices. So later I should share with you what are the key levels to watch on the Hong Kong 33. But based on this early morning positive news flow stating that potentially Apple and Alibaba could form a partnership to form some kind of iPhone localized iPhone intelligent features cater to the Chinese market. So the Hang Seng is up by 1.4%, the Hang Seng Tech is up by 1% or so, and the HSCI is up by 1.4%. But this is not confirmed news, and do not forget over here is that there's still this ongoing US China tech rivalry, and given the current US White House administration that is pretty much hawkish towards China development in the area of high technology. So I'm not so sure Apple being one of the key crown jewel of the US economy, whether the US government is about to allow this partnership to happen for the sake of US national security. So things could be pretty much fluid because this particular news flow over here is not actually in 100% certain over here. All right. So, but what's interesting in terms of the sentiment, if you were to look at this 1 month rolling performance, okay, let me share with you. There's this particular chart here. Yeah, this is the 1 month rolling performance as of now we are speaking. So it's a rolling 1 month. So if we look at the Hong Kong 33, which is the China big tech stocks do have a significant weightage in them, Alibaba as well, has been outperforming the major US stock indices like the Nasdaq, especially against the Nasdaq and the 100, so and the SPX. So among the major US stock indices, the one that is underperforming the worst is the one that is heavily concentrated in the mega cap US technology stocks, which is the Nasdaq 100, which is only showing a 1 month rolling performance gain of positive 4%, whereas the Hong Kong 33 right now is almost more than triple the gain at up at 14%. And also one of the reason because also due to this DeepSeek as well, where I explained in my earlier daily dose, saying that market participants are not aware that a US company, AI driven company that has a higher operational cost may not be so priced in their current, may not be so correctly priced in their current high valuation, because competition is now up from a lower cost model, open source model like DeepSeek, that could potentially we call it operate at a lower cost. And with that, money flows from speculator has starts to flow back into China related stock market. And yesterday there's this Reuters news flow based on data made from Goldman. He quoted Goldman over here saying that now China tops hedge funds shopping list so far this year. So short-term speculators in terms of hedge funds are now flowing back into China risk assets. So that also explained to us why right now we start to see that that Hang Seng index outperformance against the US major stock indices, and this could be a key development stretching from a multi-month perspective. All right, so with that, that is the key news flow data, and as well as the relevant intraday movement and impact on the various key cross asset classes. All right, so now let us now have a deep dive into the intraday technical outlook on the major cross asset classes, starting with the FX market. But before that, let me expand my screen so that you guys could have a better view on the charts and the key levels that I'm about to share. All right, over here. So let's start with the FX market. All right, starting with the euro dollar. So the euro dollar, yes, yesterday initially it spiked up, but it can't break above the resistance level, which is at 1.036, a bit of excess right below the 20-day moving average, and as well as this minor descending trend line that is still in place since the high of 27th of January this year. So it seems to us that this euro dollar is still kind of trapped in this kind of minor symmetrical range like configuration, minor symmetrical triangle range-like configuration in place since the low of 13th of January. So yesterday it hit the upper limit of this minor symmetrical triangle range configuration. And right now, the RSI has just exited from its overbought zone as well that was being hit yesterday during the later part of the US session. So with that, we will still maintain that intraday bearish bias within this symmetrical triangle range configuration on the minor time frame. A bit of excess above yesterday's support at 38.60 will be at 38.90. So excess 38.90 short-term pivotal resistance level. Near-term support level to watch out for will be at 1.0330. A breakdown below 1.330 may expose 1.0270 next. Okay, 1.0270 next. All right. Only an hourly close above 1.3890 and a breakout above it invalidate today's intraday bearish bias within this minor symmetrical triangle range configuration to see a potential we call it a push up to revisit 1.0440 slash 1.0460. Above it may start to see the extension of the mean reversion rebound to test the next intermediate resistance at 1.0530, which is the minor swing high area of 17th of December and 27th of January that got rejected recently. Right, so that's for the euro dollar. Now, turning our attention now will be the sterling dollar. So the sterling dollar also did a push up, but this push up also managed to store back at the 50-day moving average and this graphical resistance zone here at 1.2460, 1.2490, and as well as the hourly RSI now has starts to exit from its overbought region that was made yesterday during the US session. And what we could see over here is that potentially this pound dollar or the sterling dollar could also be trading in this kind of triangle like pattern. Okay, this kind of triangle like pattern. So this is more like a ascending wedge kind of pattern formation with the top of limit of the wedge at 1.2580 slash 1.2610. So with the exit of the overbought level that was being met yesterday during the US session, there could be a risk that it may do another potential slide within the towards the lower limit of this minor ascending wedge like formation. that is in place since the low of 13th of January. So with that, I'll be using this 1.2460 / 1.2490 short-term pivotal resistance level, which is also confluence with the 50-day moving average that has been acting as a resistance since a recent retest on it on last Friday, 7th of February. First support level to watch will be at 1.2390. Only a breakdown below 1.2390 today potentially exposes 1.2325, which is also the lower limit of this ongoing, that is formation of this minor ascending wedge support level as well at 1.2325. Only an hourly close above 1.2490 invalidate today's intraday bearish bias to see a squeeze up to expose the next intermediate resistance zone at 1.2580 / 1.2610, which is the top of this minor ascending wedge formation, and also correspond to the minor swing high of 30th of December and 7th of January this year. Okay, so that's for the sterling dollar. Now, with that, let us focus now on the Asia Pacific currency against the dollar. So the Aussie dollar also managed to did a squeeze up, but this squeeze up also paused at this former dotted line here. What's the dotted line? This dotted line is in fact a minor ascending trend line. Now turns into a pullback support and slightly below the medium-term pivotal resistance that we have earlier at 63.30. So now there could be some sign of hesitant by the bulls for the Aussie dollar despite that earlier squeeze up that was seen in today's Asia session. So using 63.30 as my pivotal resistance for today, there could be a risk that the Aussie dollar may revisit back again this minor sideways range configuration that is in place since the high of 6th of February. So you look at the 6th of February right now, all the way down to the current price, it seems to be trading in this kind of minor sideways range configuration. So breakdown below 62.80 potentially expose the lower limit of this minor sideways range configuration at 62.40 / 62.25. So only a hourly close and a push up above 63.30 invalidate today's intraday bearish bias within this minor range configuration to see a minor bullish breakout to revisit 64 figure level. 64 figure level will be psychologically a psychological level, and as well as if you look at the daily time frame chart, you also the former previous major bearish breakdown trigger level. Why is it a major bearish breakdown trigger level? Because of this former range complex range support, that major one that is in place since 13th of October 2022. Previously from 13th of October 2022, it has been trading in this kind of very complex sideways range configuration, and the bearishness of it of the Aussie dollar only takes shape on the 11th of December when this major range configuration broke down below 64. And right now this 64 is also an important level right now because it turns into a former major range support turns into a major pullback range resistance right now. All right, so that's explained to us the Aussie dollar key levels to watch for today. So first resistance will be at the 63.30 medium term pivotal resistance. There's a risk of it shaping towards the minor range support zone that is in place since the minor range configuration that took shapes on 6th of February high. But you got to break down below 62.80 before a chance to potentially exposing the range support at 62.40 / 62.25. So that's for the Aussie dollar. So now lastly will be a dollar yen. So dollar yen, yesterday we do have a bearish bias below 52.90. So in today's Asia session, it managed to do a squeeze up. So this squeeze up likely kind of triggered stop loss level. And right now the hourly RSI is in a extreme overbought level on the minor term basis, because this level is almost the highest since close to about 2 months ago, which is 19th of December last year. So with that, it's now also coming very close to the 20-day moving average as well as this former dotted line here, which is the minor range, minor trend line support now turns into a pullback resistance at 154.50. So with that, we will flip to a neutrality stance for today. So neutral between 154.10 and 154.50. Lower limit of the neutrality zone will be the 200-day moving average, now acting as an intermediate near-term support level at 152.90. Only a breakdown below 152.90 potentially may expose or reinstate the bears, the minor bears, to gain a foothold at the next near-term support level at 15160. Break down below it, potentially revisit 15095 slash 15070. However, if you start to see a squeeze up above 15450, then potentially this mean reversion rebound may extend further towards the next intermediate resistance over here at this level of 15585. Next, okay, let me put it in writing. 155.85. Next. All right, so we will flip to a neutrality stance for today for the dollar yen. So neutral between 154.10/50, and the lower limit of the neutrality zone will be 152.90 over here. So up next will be the major stock indices, starting with the Hong Kong 33, that is representing the Hang Seng index over here. So with that, if you look at the short-term pivotal resistance level, it managed to actually retest it again in today's Asia session. Then thereafter, it formed a hourly bearish candle. So and the hourly RSI continues to actually inch high lower by printing a lower high. Okay, a lower high, right? A lower high compares to yesterday high. So what I could see over here is that there's still some hesitant by the bulls to actually probe above the 21,710, 21,800 short-term pivotal resistance that we predefined yesterday, and also the momentum indicator on the hourly basis, which is a minor time frame basis. The hourly RSI is also not that great in terms of showing an uptick in bullish momentum. It doesn't show that. So with that, we will still maintain that intraday bearish bias to potentially see that mean reversion, another round of mean reversion decline to take shape. So yesterday there was this mean reversion decline. So potentially today that could potentially form another mean reversion decline on a minor scale. First support level to watch will be 21,295. That was yesterday's intraday low. A breakdown below 21,295 exposes this 20,980 slash 20,830, a very clear congestion area from 4th of February to 6th of February, and as well as the lower limit of this ongoing minor ascending channel that is still in place since 13th of January. So only a hourly close above 21,800 will invalidate today's bearish view on that minor mean reversion decline to skew up and flip back to the impulsive up move sequence, exposing the next near-term resistance at 22,000/22,005, the 1.382 Fibo extension from the low of 13th of January. Above it sees 22,470, which is a 1.618 Fibo extension, and the congestion area of 3rd of October and 4th of October last year. So that's for the Hong Kong 33. Moving on, next will be the Japan 225. So no change on the Japan 225 as it continues to inch down lower after a test close to it at the 39,310 short-term pivotal resistance that we have yesterday. So we still expect the Japanese 225 or the Japan 225 representing the Nikkei 225 to trade in a minor sideways range configuration that is in place since 3rd of February. We in a medium-term range configuration that is still in shape since late September last year. Okay, so it's something like a range, a small range within a larger range. So now yesterday it has a rejection close to the upper limit of the smaller range, which is at 39,310 short-term pivotal resistance level, and it hasn't hit the bottom of the minor range again. So we could still have that bearish view for the Japan 225. First support level to watch will be at 38,380/38,140, which is the swing low of 13th of January and 17th of January this year. Only a push up with an hourly close above 39,310 invalidate this bearish view within this minor sideways range configuration to see a squeeze up towards the upper limit of this medium-term range configuration that was in place since late September last year. Next resistance zone to watch in the first step will be 39,710/39,830, which is the minor swing high of 31st of January. All right, 31st of January this year. Now, flipping our attention will be the European stock market, which is the German 30 or the German DAX. So the German DAX going to rally as expected, almost hit our resistance level at 22,160. Hourly RSI, yes, is overbought right now, but there is no signs of a bearish divergence, no bearish divergence. So there could be a chance of a minor pullback rather than a deeper mean reversion decline scenario that could take shape. So with that, we will have a very tight short-term pivotal support level for today, which is the former minor swing high of 7th of February and 11th of February. Previously did about hesitation before it broke through in yesterday's start of the US session. So using 21,945 to hold any potential minor pullback, we will still maintain that intraday bearish bias. Above 22,160 will potentially see a bullish acceleration above this upper limit of this medium-term ascending channel that is in place since 19th of November low. So above 22,160 exposes the next resistance zone on 21,385/485, 21,385/480, pardon me, which is defined by a Fibo extension clustering level techniques. So only an hourly close and a breakdown below this Titan key short-term pivotal support level at 21,945 will invalidate today's intraday bullish bias on the German 30 to potentially kickstart a mean reversion decline scenario on a minor scale first, exposing the next near-term support at 21,746. Below it, potentially sees 21,510 next, which also correspond to the rising 20-day moving average. All right, so now onwards next will be the US stock indices, starting with the US Wall Street 30 that is representing the Dow Jones Industrial Average. So no change as it continues to be congested within this kind of minor symmetrical triangle range like configuration that is in shape since the high of 31st of January this year. All right, so with that and that also is the close to the all-time high area as well, the 45,095, 90, 45,100. So with that, we will still maintain that neutrality stance like we have yesterday. So neutral between this 44,840 and 44,250 for now. So only a breakout above either these two level, 44,840 and 44,250 will give us some clue on where is the potential levels to watch. So above 44,840 sees the current all-time high at 45,090/100, then thereafter 45,500/700. However, a breakdown below 44,250, which is the lower limit of this symmetrical triangle range configuration, and the 20-day moving average as well, that is acting as a similar support level at 44,240, potentially unleash a mean reversion decline scenario first in first step, exposing the next support zone at 43,730/600, which also correspond to the 50-day moving average, acting as a similar support area as well. Now onward next will be the Nasdaq 100. So for the Nasdaq 100, no change. He almost hit the first support level at 21,570 yesterday, which is a low of 21,588, give or take almost the same, and also the 20-day moving average that is acting as support as well, before shaping the bounce during the later part of the US session. Then thereafter, at the close of the US session, it can inch much higher and inch slowly lower as it fast approach this short-term pivotal resistance zone that we have yesterday, 21,845/21,945. So still no change, still maintaining that intraday bearish bias within this kind of very complex sideways range configuration that is in place since the high of 23rd of January, kind of a close to about 2 months, coming to 2 months plus of complex range configuration, using 21,845/945, the upper limit, as my short-term pivotal resistance level, still maintaining that short-term intraday bias to potentially float down towards the lower limit of this complex sideways range configuration. But in first step, it got to break down below 21,560 first. That managed to survive yesterday. A breakdown below this level potentially open up scope to the next near-term support level to watch for today will be at 21,340 next. Only a push up and the hourly close above 21,945 will invalidate today's intraday bearish bias within this complex sideways range configuration to see a squeeze up to revisit or potentially retest the current all-time high area or all-time high level at 22,135, which has been which was printed on 17th of December last year. All right, so that's for the Nasdaq 100 and also sum up the intraday technical outlook for the major stock indices. So now onwards, next will be the commodities market, starting with gold XAU slash USD. So let us take a look at the daily chart of gold XAU slash USD first. So for gold, it hit our resistance level at 2,900, 2,940 previously. So yesterday it formed a spinning top formation with a small little doji body, but a long candle. All right, so this could be also a spinning top over here, a spinning top, because the doji is in the middle of the range, not at the bottom. So with this kind of spinning top formation, right at a resistance level and also at the upper limit of this major ascending channel from the low of 6th of October 2023, there could be some form of at least a pullback taking shape on the spot gold XAU slash USD chart over here. So potentially after that very strong push up, after 2 weeks of range configuration that was in place, or 2 months of range configuration that was in place since mid of November, and we have the bullish breakout on 21st of January. After this bullish breakout, it start to see a very steep up move. So after this very steep up move, potentially there could be some kind of minor pullback in first step first. So if the minor pullback start to break certain short-term support level, then this minor pullback could potentially unfold into a multi-day pullback sequence. All right, from here. So with that, let us take a look at the intraday chart for gold, which is on the hourly chart, to guide us our key levels and trend bias to watch for today. So with that, because of that spinning top that was seen at the 2,940, 2,945 level, so this will be my short-term pivotal resistance level for today. We will flip to a intraday bearish bias, given the appearance of that daily spinning top candlestick at the end of yesterday US session. So no high conviction to maintain into a bullish stance as of yesterday. Because yesterday we maintained bullish stance using 2880 as my short-term pivotal support level, but because the higher time frame daily chart is not so bullish in terms of element, so we will flip to an intraday bearish bias, potentially for at least in first step a minor pullback sequence may form at this juncture for gold XAU slash USD. So using 2,940 slash 2,945 short-term pivotal resistance level, a breakdown below 2,880 open up scope in first step to expose the next near-term support level at 2,845. Below it, potentially sees the next support zone coming in at 2,812 slash 2,795. We also correspond to the lower limit of this minor ascending channel from the low of 30th of December, and as well as the rising 20-day moving average as well, that is acting as a similar support zone at 2,812 slash 2,795. So potentially right now, there could be a chance that gold may start to do a kind of a minor pullback sequence first, in first step, after the very steep short move from the 2 months of range bullish breakout that was seen on late January this year. So however, hourly close above 2,945 will invalidate today's intraday bearish bias to see the continuation of the impulsive up move towards 2,990 slash 3,000 next. Right, so that's for gold XAU slash USD. Lastly will be the West Texas crude oil. So for West Texas crude oil, yesterday it managed to break above the 50-day moving average, which is also our short-term pivotal resistance zone over here at around the 72.70 level mark. So right now, it seems to us that it is potentially trying to do a mean reversion rebound scenario to retrace certain portion of this minor decline that was seen from 16th of January high all the way down to the low of 7th of February. All right, so we know that price action don't go vertical down. There will be a chance of a mean reversion rebound. So potentially now it could be that chance of that mean reversion rebound to take shape and at a higher probability given yesterday's breakout above the 50-day moving average that was previously acting as a resistance. So for today, we will flip to a intraday bullish bias to see this mean reversion rebound scenario to play out further, potentially on West Texas crude oil. The support level to maintain this intraday mean reversion rebound scenario will be 72.50. That will be my short-term pivotal support, very close to the 50-day moving average as well. And if we will do the Fibo retracement of this push up from the low of 7th of Feb all the way up to the high of yesterday US session high at 73. Give me a minute, what's this level? yeah, at 74 figure level is close to the 50% Fibo retracement. So as long as this 72.50 short-term pivotal support holds for today, we will flip to an intraday bullish bias for this potential mean reversion rebound scenario to play out on West Texas crude oil, potentially retest the downward sloping 20-day moving average and the 200-day moving average that is confluencing at this similar resistance zone at 74.67 slash 75.16 nicks. Only hourly close and the breakdown below 72.50 will invalidate this intraday bullish bias for the mean reversion rebound scenario to get invalidated to see the continuation of the impulsive down move sequence. In first step, revisiting 71.05, breakdown below 71.05 exposes 69.80 nicks, which is the minor swing low area of 27th of December. All right, so that sum up the intraday technical outlook on the West Texas crude oil and as well as the intraday technical outlook on the major cross asset classes. So before we go, let's take a look at the economic calendar. What are the data to look out for today? So today will be this Thursday. All right, Thursday. So if we go to, so sorry, today will be Wednesday, pardon me, not Thursday. Okay, I don't know why it's on Thursday. So today should be Wednesday, the 12th of February. I don't know why I keep on talking Thursday. So pardon me about that. So Wednesday. So for today, Wednesday over here, during the European session, there is no key things to look out for during the European session. The key thing will come up during the US session at 9:30 p.m. before the start of the US stock market, which is the inflation data. So market will be focusing on the core inflation rate, which has been stabilizing around the 3% level. So market is now looking at a slight dip to 3.1% from 3.2% that was printed in the previous month of December. So anything that is above 3.1% at 3.2% or 3.3%, that could also represent a kind of a stubborn inflationary environment in the US that potentially align with the Fed Chair Powell Fed Chair Powell testimony to Senate yesterday, saying that the Fed is in no rush of cutting rates. All right, so that could actually see an impact on the FX market and as well as the movement of the major stock indices. So something to look out for today at 9:30 p.m. Singapore time. And also at 11 p.m. we have one of the BOE official speaking, BOE Green official speech at 11 p.m. and also the second Fed Chair testimony to Congress. So today he will address not the Senate but the House instead. Okay, if not, it should be the house. Yeah, the house members. So more or less, I think it shouldn't change in terms of tonality, but something to look out for as well, just in case Fed Chair Powell want to inject some new guidance in the US monetary Federal Reserve policy. So that is at 11 p.m. Singapore time, and at 11:30 p.m. Singapore time, we have the weekly US EIA crude oil stockpile change that may potentially impact the intraday movement of the West Texas crude oil. And thereafter, should be rather quiet over here. Yes, yep, no other key data and event to look out for. Right, so with that, that sum up today's daily dose of market insights. I'm Kelvin here, signing off, and I wish you all a great day ahead, and we shall speak again tomorrow. Thank you very much.